It's so good to have you with us. My first question to you is, what does Kevin Warsh becoming the next Fed governor mean for you, for the markets, and for the independence of the Federal Reserve?
Thank you for having me. I think it is very good news across the board because Kevin is someone with a tremendous amount of experience. He was a governor of the Fed at a very important time. He has significant expertise in economics and in markets. He communicates extremely well, and he understands that you need to modernize the functioning of the Federal Reserve. So he is very good news in terms of putting this institution that's so critical, not just to the US well-being, but to the global well-being, in the hands of someone with experience, expertise, and an understanding of what needs to be done. For the market in the short term, in the very short term, he will be viewed as less dovish than the alternatives that were mentioned. So as the rumors started going that he was the front runner and he's likely to be nominated, you saw the dollar strengthen, you saw interest rates go up a little bit. And that is a relative statement because people also thought it could be some of the others who are seen to be much more dovish. Finally, what does it mean for the independence of the central bank? It means an ability to reinforce independence. You know, independence requires accountability. And accountability for your mistakes, accountability for being able to take a view of the future and not being just data dependent. And Kevin Warsh fundamentally understands that. So I think that as he reforms the Fed, there will be less of an inclination to try to reform it from outside, which is what has happened in the last year.
The strength of the dollar that we have seen, is this a trend? Because we all know that the dollar weakness was the main theme that we saw last year. Since President Trump became president in his second term, we have seen a 10% drop in the dollar. So are you worried about the weakness that we are seeing in the dollar?
I think that there's a good chance that over time the dollar will be range bound. But if it breaks the range, it's more likely to go weaker than stronger. And there's two main reasons for that. One is that this US administration doesn't mind a weaker dollar. You heard President Trump. He sees that as increasing competitiveness of US industry, and you see it as also attracting more inflows into the US. And the second reason is that some parts of the rest of the world, particularly in Asia, feel they are overweight the US, overweight the dollar. So you've seen them buying gold, seeking to diversify. So if we break the range, it's more likely to be to the weaker dollar than the stronger dollar.
And the weakness in the dollar, it's mainly one of the reasons is because, as you have mentioned, investors are selling the dollar and buying gold, and we are talking here about institutional investors in addition to central banks. We have seen volatility in gold prices, unprecedented volatility, and we have seen unprecedented gains in gold prices. Where are you seeing gold prices heading?
So, you know, a year ago, I remember being asked, where do you see gold prices heading in 2025? And I said 5,000. And people thought that was silly. And as it turned out, we didn't get to 5,000 until January of 2026. So why? Because of what you mentioned. First, central bankers in Asia in particular had become regular buyers of dollar, month after month after month. Secondly, institutional investors have much more interest now in gold, which is viewed as a safe haven, a better safe haven than bonds. And then finally, speculators, when they see institutional buyers, be them investors or central bank, they will buy gold. So this is what got us to these levels. From here, it will be a much more volatile journey. We will see gold prices swing quite a bit, but it would not surprise me if we get to 6,000 in 2026.
But do you think central banks will continue to buy gold, at these record levels?
Yes, I do. These are what are called non-commercial purchases. They are being bought not to make money, but to meet another objective. And in this case, it is to reduce the holdings of dollar and to introduce a new risk mitigator. So yes, they will continue buying, They may buy a slightly slower pace and then a faster pace, but there will be net buyers going forward.
How about silver? Silver, silver has been. Is it actually a safe haven for the dollar? How do you explain this rise in silver? Because we know silver was also, we have seen funds going to silver, but at the same time there's an industrial use for the silver. So should we be worried about a deep correction in silver prices?
So a deep correction is possible in both gold and silver, but my sense is that it will be reversed if it happens. Silver is a derivative trade of gold right now. People look at silver, they think it's cheaper because of the way people think, $100 versus $5,000. That's just a behavioral thing. And they think of it as being the turbocharge bet on gold. And that's why it has had an even more extraordinary increase. So yeah, it will trade with gold, but with a much higher volatility than gold.
Deep correction of gold, even if central banks are, you're predicting central banks to keep on buying?
It is possible because there's so many speculators in the trade right now. You know, when you get asked, there's this famous thing that when your taxi driver starts asking about an asset, be it Bitcoin, be it something else, it's become too popular, and you have to be careful on that.
Doctor, one thing also we're watching is what's happening in the bonds market, especially Japan. Yields are at all-time high. There's a bit of worry about that, especially that we have trillions of dollars of Japanese capital invested abroad. So are you worried that this capital will come back to Japan and that will affect asset prices outside of Japan?
That is certainly a concern, and at some point earlier in January, the sell-off in bonds seemed disorderly. And that's when you start worrying on that, because when you cannot sell what you want to sell, you sell what you can sell. So suddenly you start selling other assets. So the concern is, as you absolutely correct in saying, is that Japanese are very large holders of foreign assets. And they may need to sell their assets because of what's happening in the Japanese bond market. I think the bigger point, and I keep on mentioning this, is that in the old days, the bond market would attack emerging economies. Argentina, Brazil, Thailand. In the last 3 years, we've seen the bond market get impatient with the UK, with France, and with Japan. That's 3 of the 7 G7 countries. And I think that that's the reality, that now no country is immune to the bond market feeling impatient.
Are you worried of any crisis that we might see because of that? Is there a risk of any crisis, a debt crisis in 2026?
Crisis is a strong word. Is there a risk that the bond market loses patience with all that is being asked to fund, hyperscalers, tremendous demand for capital to build data centers, is being asked to fund very large government deficits in most advanced economy. Corporate, household, is there a chance that it will lose patience? Yes. Do I think we get anything like 2008? No. So we will get market volatility, we'll get more fragmentation, but I do not believe we'll get a 2008 crisis.
Doctor, today, when equities are at all-time high, in different geographies, in different markets, when metals are at all-time high, where should someone invest right now?
So I get asked that question all the time. I get people who stop me in airports, literally stop me in airports, and say, should I do this? And I say, first, I don't know what your objective is. Is it a short-term objective? Is it a long-term objective? I don't know. Secondly, I don't know what your risk tolerance is, because the worst thing that happens to investors is that they panic. When prices go down, even of good assets, they sell them on that. So I don't know what your risk, and I don't know what else you own. So I tell them a few principles. First, do not rely on stock markets for your next 6 months. Okay, because they are volatile, and we are, like you said, all-time highs, and we may get a correction, and you don't want to be forced to sell. Second, ask yourself the question, which is very difficult to ask. Not what could be my mistake, what could be my unrecoverable mistake, non-recoverable mistake. I think if people ask that question, they would probably reduce at the margin their holding of equities. And they would probably go more in cash, wait to see how all these uncertainties play out. Because right now, as you say, we are at very high valuations.
But even there's a question about the fiat currencies, and there's less confidence in fiat currencies, and holding cash can make you actually lose money. So why would they hold cash right now?
So cash is a risk mitigator. Is it a perfect risk mitigator? No. And that's why a lot of people have been buying gold. They see that as a bet. But relative to equities, it is a risk mitigator. And what one realizes is that one is forced to live in a relative world, not an absolute. So let's take the dollar. The dollar is a reserve currency. Are people as comfortable with the dollar as they were before? No. But where else are you going to go? Are you going to go to the euro? No. The European economy is not where the US economy is. The US economy is stronger. Will you go to the Chinese currency? No, it's not fully convertible. So when it solves in this world of relative space, people either slowly diversify away or say, you know what, it may not be perfect, but it's good. I take the example, suppose you're on a business trip, and suppose your trip gets extended for one day, and you cannot go to the laundry. You will wear your cleanest dirty blouse. I will wear my cleanest dirty shirt. And cash, and particularly dollar cash, is your cleanest dirty shirt. It's not pristine, but it's cleaner than anything else in the closet when it comes to currencies.
Thank you so much.